It is just a huge honor for me today to be podcast interviewing Mitch Tuchman. He's the co-founder and managing director of Rebalance. Tuchman began his career at Atari and spent this first half of his career as Silicon Valley software entrepreneur until 1999 when he sold two startups, C2B Technologies and Net Market Makers during the dot-com period. He then entered investment management with Apex Capital, where he oversaw a $200 million technology portfolio, co-managed its venture capital fund, and served as director of 4 NASDAQ companies as an active investor. He soon noticed that the commission-based broker model pervasive in the financial industry was the reason most investors were suffering from poor returns, and saw an opportunity to use technology to lower costs and emulate the best practices of sophisticated endowments like Yale and Harvard. He founded the first robo-investment firm, MarketRiders, in 2008. By 2012, Tuchman noted that robo-investing needed a human touch, and he partnered with Scott Puritz to form Rebalance. They recruited an all-star investment committee with Princeton economics professor Burton, Malkiel, author of the classic investment book, A Walk Down Wall Street, Dr. Charles Ellis, the former longtime chairman of Yale University Endowment, and Jay Vivian, the former managing director of IBM's $100+ billion retirement investment funds. Today, Rebalance manages nearly $1 billion in client retirement assets with its innovative and breakthrough business model for retirement investing. Thank you so much for coming on the show today. How are you doing, Mitch?
I'm good. That was a little lengthy bio. I guess we could have cut that back a little bit, but thank you, Howard. Thanks for bearing with it.
And Mitch, the reason I asked you to come on the show, you didn't ask me. I don't do paid guest spots. I mean, these are all legitimate, organic, but I have to admit my bias is my selfish bastard myself. My gosh, I'm 58, Mitch. I graduated from high school in 1980 when Paul Volcker had interest rates at 20%, double-digit inflation, unemployment. I graduated from dental school May 11, 87, and September was Black Monday. My gosh, we had the Y2K bubble pop, and then we had Lehman's pop in 2008. And I'm not a palm reader. No one can predict the future. But Mitch, does it kind of smell like we're in a bubble again?
Parts of the market are in a bubble. I mean, maybe parts of the S&P are in a bubble. You got to remember, Howard, there's an old expression, the market climbs a wall of worry. There's always something to worry about. Every time I do a show, every time I'm interviewed, there's always the worry of the day. The worry of the day today, and remember, we just went through COVID, which is one of the worst experiences any of us as investors will ever go through. But the worry of the day now is that, maybe some of the markets overheated. And when you say the market, remember the market you're referring to is the S&P 500, where 60% of the growth in 2020 was from about 5 or 6 stocks. So is the market overheated? Well, there are markets that are not overheated. So real estate market's not overheated. Europe and Japan are not overheated. Many of the emerging markets are not overheated. Dividend-paying stocks in the U.S. are not overheated. So that speaks to the need to really know what you're doing to be diversified. But I would contend that there's a part of the market that's always overheated. And yes, right now, the one that we hear in the news and the media every day of our lives perhaps is overheated. I don't know.
I mean, dentists, they just talk about this all the time about retirement and who can do it at what age. I think when you have a really unglamorous job, how's that for a word? When you have kind of an unglamorous job and you're stressed, and whenever dentists have a bad day, they always start thinking about retiring. And
sure.
I called you. I love your posts on Dental Town. I mean, and I love your continuing education course that you put on Dental Town. But from all your experience of dealing with these massive pros that do these big endowments at Harvard and Yale and IBM and all this stuff, what do you think the little guy dentist? What do you think he or she's getting right, and what do you think she's getting wrong on average most of the time?
Okay, well, there's 2 parts to that. That's a great question. So there's the part where you're running a practice and you have various vehicles for socking away money and having the government pay half of that, right? Like a 401k plan, depending upon your income. There's other ways to defer money up to hundreds of thousands of dollars a year. So the two-part answer to the question is on the retirement, the mechanics, the put it in right, make sure the fees are low, get the nomenclature of socking away pre-tax money. That's one big piece, getting that set up. And then the other big piece is once it's set up and money's flowing in, making sure that the money's invested properly. So I could address each one if you'd like, but it's really a two-part answer. The dentists that I know who that we've worked with that are successful and can retire and have the ability to retire, or are on a very believable path that when they wake up freaked out about whatever or stressed out about whatever, they can look at the path and go, yeah, it'll be okay. Those that, get on that path or are on that path or have made it through that path, don't stress about this stuff. I mean, they don't talk about it. They just know it's going to be fine. And I think there's a way to get there psychologically, but you got to have the knowledge and some of the pieces in place to feel secure about that.
Well, the biggest thread on Dental Town, I mean, my gosh, it's called 3% Can Retire at 60. Dental Town retirement planning thread. And that thread is a gazillion miles long. And I wonder if you've seen that thread and what your thoughts are on it.
I haven't seen it, but look, that's an old rule of thumb in my business. It's really kind of irrelevant for most people. I mean, it really is. Usually everybody's situation is different. I mean, 3%, the rule of thumb of 3% is there because in my business, you would say, if I can achieve a net portfolio return of about 6% and I take out 3%, in other words, half of it to live on, then it leaves 3% in the portfolio to continue insulating me from inflation over a long period of time. So that if I retire at 65 and I'm enjoying great steak dinners at Morton's, when I'm 85, I can still enjoy them when the steak goes from $50 to $85 a steak, right? I mean, that's just the point. You got to let something grow to appreciate for inflation. So that's the rule of thumb, 3%. But that, we found, we do intensive financial planning for our clients at Rebalance, and some people can live on 2, some need 5, and then, but it all depends. I mean, some people say, hey, I'll live on 5 or 6 and I won't insulate myself from inflation. And when I'm 90, I won't leave anything for my kids, but I'll be okay. So it's just a very individualized thing. That's like saying there's some rules of thumb about doing a tax return for you specifically without knowing, do you have rental properties? Do you have depreciation? What state do you live in? Do you have state tax? Do you have no state tax? So for dentists to be pontificating about 3% is it's sort of a waste of time.
Well, one of the biggest shows on retirement planning was back in 2016 when John Oliver did this show. John Oliver, Fiduciary and the Retirement Challenge. And I mean, I think when I went to bed the night before, I don't think 3 Americans knew what a fiduciary was. And after John Oliver did that show, it's all they would talk about on Dental Town. What did you think of his program on that?
Well, it was great because look, this is what happened to me. I mean, I got through the .com and I had made money to change my life, but my son was born around the same time with severe disabilities, and I said to myself, I can't screw this up. I have got to make this money last in perpetuity. Who does that? Who does that really well? And I pulled all my, I have a Harvard MBA, so I have a lot of people who I can talk to about this and get very intelligent answers. And none of it made any sense because when I went to talk to people on Wall Street, I couldn't understand the following thing, Howard. I couldn't understand how somebody could sell me an investment product and make a commission and always have my best interests at heart. Like, how could that be? Like, how could I know for sure that he wasn't just spinning me something new, a new fund, a new stock, such that he could pay his kids' college tuition that night, right? I never knew. So the commission-based model is inherently full of conflicts. And by the way, one of the reasons our firms built the Better K product to get into the 401k business is because most dentists out there have 401k plans with conflicts written inside the plan. So the conflict idea is that I sell you something, I get paid an incentive commission to pay to give it to you, and that makes me not a fiduciary. So the reason it rings true for dentists so much is that dentists take a Hippocratic oath as a medical doctor. Do no harm. right? Do no harm. Well, if you want to take that same oath in my business, you have to say to yourself, I'm going to run a business and I'm only going to be paid a fee based on what I'm managing for the clients. And I will not take commissions. I will not sell life insurance. I will not put you in a 401k plan where I'm getting vigorish on the side, through the funds that I'm putting in your plan. All that stuff, which is written in the financial service industry, which siphons wealth out of people's accounts in a very silent and hidden way, that should all be off the table. So that's why John Oliver's thing was so powerful. And by the way, when John Oliver's program was on the air, that was during the Obama administration's work to put the fiduciary rule through with the Department of Labor. And our firm and my partner, Scott Puritz, who I'm very proud of, was the only investment professional as a fiduciary asked to testify in front of the Senate. And he testified in front of Elizabeth Warren and other senators on behalf of this fiduciary rule. So yeah, the reason a dentist really gets this is because it's the same way a dentist does business. Do no harm. And you can't not, you do harm if you're in a business where you're charging commissions for giving people advice about where they should put their hard-earned money.
The founder of Vanguard passed away last year. He was a legend. And my gosh, he really changed the world with these index funds.
Yep.
What are your thoughts on him and how it changed the world?
Well, first of all, Jack Bogle is a legend, and one of the things people don't really understand is that he formed Vanguard as a nonprofit organization. Howard, have you heard of any billionaires from Vanguard?
No.
Well, there aren't any. Bogle died with, I think, some money, but he formed this company as a nonprofit organization through the mutual fund structure. And what happens with Vanguard is the more funds they manage, the lower their fees go. So that's what's one of very fundamental things. So the guy put his money where his mouth is. He started what's now today first or second largest fund company in the world, and it's a nonprofit. The idea of the index fund is fundamental to what we do at Rebalance. It's totally core. And what it is, it's really comes down to two things. Do you believe that you can hire some human being who has superior forecasting skills, analytic skills, trading skills, market timing skills to beat a particular part of a market? Do you believe that? And if you believe that, then you won't buy an index fund. If you believe that, John Gonzalez, who's a wonderful trader with great skills and an MBA and all this stuff, can buy stocks in the S&P and beat the S&P, then you will not buy an index fund. You will engage in what we call active management. Bogle proved, and by the way, Bogle proved with the help of our investment committee member, Professor Burton Malkiel, that was a false promise, that was a siren song of Wall Street, that people can beat the market. And his thesis was, well, I've proven that the pros really don't beat the market. In fact, generally the market beats the pros. And if that's the case, why not just create a fund run by computers that owns the whole market and buy that and keep the fees low and allow the investor to realize the great returns that the market gives them? And that's the fundamental idea of index funds. So either you believe people beat the market, which is what runs on CNBC all day and night, and all the market forecasters and prognosticators, they're all basically saying, at the end of the day, I have an edge. I can use that edge to do better than everybody else. The indexer says, I give up. I capitulate. There is no edge. The markets are going to randomly move around, and I just want to own the markets because over time I'll get a very satisfying result. We base our whole company on using index funds, Howard. So we put them in our 401k plans. We put them for our individual clients, and it's really to us the only way to do it. The fees alone give you a huge edge over anybody trying to beat the market.
And did John Bogle actually invent the index funds? I know he's the founder of Vanguard, and I did not know that it was essentially a nonprofit because basically it's owned by the investors in its funds. Therefore, any profits it earns are returned to the investors in the fund in the forms of lower fees. But did he actually invent that space?
Yes. And guess when he invented it?
When or why?
When?
Mike.
1975. Okay, so this has been, nearly a 50-year phenomenon. When he invented them, Howard, the mutual fund industry freaked, and they put up these big signs with Uncle Sam and a cross through it, and they said mutual funds are un-American. They realized that he knew their dirty little secret, which is their funds don't consistently do better than whatever benchmark they're trying to beat. And they saw it. It was a death knell for that industry, but it's taken 45 years to play out. And it's really playing out since the internet, because what's happened is those that could beat the market, and I was in that business, okay, you beat the market by getting some sort of an information edge. And when you have that little edge, you can play it out. Well, 20 years ago, this little thing called the internet occurred, and that information edge amongst all the players shrunk. The minute somebody has an idea, bam, it's on Seeking Alpha, it's on a website. And there's no more edges, or there are edges, but very few and far between. So he invented it. Burton Malkiel on our investment committee wrote a book that took the fundamental underpinnings of the index fund and made it very well known through a book that's probably the best-selling book ever in personal finance. If any dentist is that interested in this, they should read it. It's called A Random Walk Down Wall Street. But he was on the initial board of Vanguard, and he's on our investment committee today. We got a lot of videos on our website on Rebalance 360 about index investing and why it's a great idea. But the world it's hit a tipping point. I think most people see it now.
Why do you think it's at a tipping point?
Well, you just look at the dollars that are now in index funds, and certain ETFs. I won't say all ETFs, but ETFs, which stands for Exchange Traded Fund, is just a kind of a legal entity in which the fund is held, an ETF. The money going into that, Vanguard and BlackRock, it's just the data is showing that it's kind of hit a point where most people understand, hey, low cost investing, Vanguard, index funds. They kind of get that. They like to do that. They don't know how to implement it, which is what we know how to do, but everybody's moving in the right direction. And the world of what's called active managers, it's suffering. It's been suffering, and it's a trend that hasn't changed at all in 10 years.
Well, here's a little known trivial fact about me. When I met the mother of my children, she worked at Merrill Lynch. And so I got a part-time job there my senior year of dental school just so I could make money and be with my wife. And I actually won the All-Missouri IRA championship. The brokers, they had a deal. And I was only working 2 hours a night, maybe 3 or 4 nights a week. And these guys are working all day, and they were there when I was there at night. But basically, it's all in marketing. Whoever has the biggest data list wins. I mean, like Twitter. I've never given Twitter $1 in my life because they can't even tell me which one of their followers are dentists. It's insane how they don't even target. But basically, back then, it was pre-computer and all that stuff. And I just got the newspaper and went to the classifieds. And I looked for people that were selling big-ticket items, big boats, yachts, all this stuff. And I call them up, and I was such an idiot. I call them up, and I say, Mitch, man, I see you're selling a 14-foot boat that you got parked out on the lake. Can you tell me about it? And he'd tell me all about it. And then he'd say, well, are you interested in buying it? I said, buying it? I'm interested in dreaming about it. I'm a senior in dental school. I don't have a dime to my name. I'm $87,000 in student loans. In fact, I'm just bored. I'm calling from my part-time job at Merrill Lynch trying to sell IRAs. And then the guy'd start laughing. He goes, well, what's that like? Then I'd explain it all to him. And my gosh, I would get one every hour. And it was all because I had a qualified lead, and you need qualified leads. It's like patients. It's like when dental offices do Groupon, you're attracting a patient that's racing to the bottom, everything free, doesn't want to pay for everything. I mean, that's just crazy. You want a qualified word-of-mouth referral, and you should spend your marketing dollars rewarding the person that referred them and making the everyday new patient experience and everyday experience so much nicer instead of just burning and churning. But I just love your profound posts. Like, most of my posts are like LOL or sure or whatever. Yours are always profound. You posted Worried about the election and your investments? You shouldn't be. Stock market returns under different ruling political parties from 1860 to 2010 show annual returns of 8.2% per year for Republican presidents and 8.4% for Democratic presidents. And I mean, that's so obvious. It's like when people say the United States has never been this divided before. It's the same when I got out of school in 1980 in high school to 2020, those 40 years, the percentage of Americans registered Republican or Democrat, it looks like a flat line. Why do you, and right now, I think the big investment theme is that you want to be in the market because Biden's going to spend all this money and he's going to give people more stimulus checks or do infrastructure or whatever. Do you think it's kind of a waste of time to look at politics and the
100%.
daily news and all that kind of stuff, trying to...
I watch it because clients call me and we have to talk about it. But for my money, I pay zero attention to it. For my concern, for my stress level, zero attention to it. Here's what I know. I just look back at the data. Capital markets, stock markets, bond markets, they've yielded a fairly stable rate of return over many, many decades, net of inflation. And you can get on that ride. You can get on that train. You can get those returns. It's very simple. It's deceptively simple. It's devilishly simple. But what you have to do, if you remember that book, The Odyssey, you got that guy with the, strapped to the sail with the women, the siren song, and the siren song is the media and your friends at cocktail parties that are pushing one of your two buttons. One is your I'm afraid, I'm freaked out button, and the other is I'm getting greedy because I'm missing out button. So one of those two buttons gets pushed, and that's the siren song. And the media is great at it. Look, what's more important after your marriage, your kids, your grandkids? It's your money. Okay. And if I can get you riled up about your money, I can get you to do something. And if I can get you to do something, I can ring my register. And that's what the whole game is about. So if you realize that and just look at the data, you can own a handful of very simple index funds with the right mix for you. There's a lot of work that needs to be done and how to do that. You'll just, in a very tax efficient way, accumulate a lot of money. Not that hard.
What do you, which stock analysts do you care what they think on TV? Take Jim Cramer. He's huge on these deals. Do you listen to guys like Jim Cramer on Mad Money for entertainment or insight, or what do you?
Well, for the average investor, that person should look at Jim Cramer. Look, if you want to be, well, let me answer your question first. I like to understand, I like interviews with CEOs. I find it interesting to understand businesses and models and what people are doing out there in the business world. Does it inform my thinking about how to invest? Does it make me say, I'm going to go run out and buy shares of those companies or whatever? No, I don't own any shares for our clients, except in rare cases of any companies. We just own funds that hold hundreds, if not thousands of stocks, which is what index investing is. But again, if you listen to Jim Cramer and you start buying and selling stocks on that, you're assuming that you're going to do better than the market. So, for most people, it's very expensive entertainment.
I go to their Wikipedia and I try to read, the basics, like, does he have a degree in economics? Is this something he does full time? And some of them, it's really hard. Like Peter Schiff. I got a couple of my kids are in love with that man. But what's your view on him?
It's the same. It's the same. Well, let's go back to Cramer for a minute. If you go back to 2008, speaking of John Oliver, Jon Stewart, where John Oliver came from, the Jon Stewart, The Daily Show, in 2008, Jim Cramer gave people some really, really bad advice about what to do during the housing bubble crisis. And it came back. People lost a lot of money following his advice. And he went on to the Jon Stewart Show, The Daily Show. And it's a great video to watch. And Jon Stewart looked at him and he said, look, you totally gave people horrible advice. And finally, Jim Cramer capitulated. And he says, look, I'm an entertainer. And that's what he is. He's an entertainer. Does he give great shows with great CEOs and interesting things to talk about? Yes. I love listening to Jim Cramer. Am I going to do anything about that? No. Zip, zero, nada. And if people understood what it takes to really understand a company, to buy the stock and hold the stock and build conviction on the stock and put enough money in a stock to move the needle, if you really understood that, if you've been in my business for a while doing that, you would never, ever go near it as a dentist. They might have a casual thought, oh, I'll buy a little Tesla, I'll buy a little of this or that. I mean, you could do it, it might work out, but stock picking is a very, very, it's a blood sport. So buying index funds is a pretty safe way to get a very good compounded return over a long period of time and not stress about it.
And but for me being an old dude, I mean, and by the way, I'm just loving this podcast. I'm interviewing you just for myself, but my gosh, I mean, like right now, Tesla's PE ratio is 1,700. If you sold all of Tesla stock at the market value today, you could buy every other car company on earth. We're talking little nobody companies you never heard of, like Honda, Toyota, Lexus, Mercedes-Benz, Volvo, Chrysler, Ford, GM. I mean, obviously he was on the Joe Rogan show smoking pot, but if he's smoking pot, what are the people smoking that are buying a stock trading at almost 2 millennium PE? I mean, have you ever seen anything that crazy in your life?
I've seen crazier, but it was during 2000, right? Where companies, with no potential. I mean, there's a good story behind Tesla and what the value it at, who the hell knows? But look, this is all fun, right? During times when everybody's inebriated and everything's going up, and it's not Tesla, it's Bitcoin. It's not Bitcoin, it's Netflix. It's not that, it's Amazon. Apple, $2 trillion market cap. I mean, come on. So, I don't know. It's all pretty interesting and insane. And the beauty of indexing is you just don't care. Let me just, a typical portfolio that we manage where there's, a good position in an all market US fund that holds a lot of the stuff we're talking about. When we do a rebalancing, I mean, what you're trying to do is manage risk. And that's the thing that we don't talk about on the financial shows. You can get returns, but what risk does you take to get the returns? Okay. I mean, I can get you a 20% return, but if I put all your money in one stock and that stock could have had an SEC investigation, it could have had fraudulent actors on the management team, it could have had a million things. It could have been Baidu years ago in China when the Chinese government began to lock down on companies like that. Anything can happen to a company. If I get you a 20% return owning one company versus a 20% return owning, thousands of companies, the risk in the latter, it's a way better risk-adjusted rate of return. But the concept of risk seems to never come into the conversation when you're talking about how did you get your returns. So anyway, I know that if I just plod along like a tortoise and compound money at 7%-ish, money will double every 10 years. If I do it with some funds that I don't have to trade out of, I don't have to realize gains in taxable accounts and pay taxes on it. I know that, 2 doubles to 4, which doubles to 8, which doubles to 16. You do that over a 30-year career, you'll never look back and say, God, I really missed out on Tesla. Because when the music ends, a lot of people are going to lose a lot of money.
Oh,
never happens. Never fails to happen,
It's going to be crazy.
What do you do? What do you do with your investing, Howard? With all your Merrill Lynch background and, how do you do it?
Well, my biggest investment was my ex-wife. That was $3.8 million. And that's why I want to tell all you kids listening that all these financial, like when you're listening to Mitch, he says, he's an amazing financial advisor, but everything he talks about has nothing to do with financial advising. Here's financial advising. If you don't get married, you're not going to get divorced. If you're worried about your $400,000 student loans, Wait till you get divorced. It's over $1 million. My student loans was $87,000. My divorce was $3.8 million. So my divorce cost 41 times more than my student loans. Same thing with kids. Student loan debt of $400,000. It's about $200,000 to raise a kid from 0 birth to 18, not counting college or anything like that. So my mom had 7 kids. So if you have $400,000 student loans, don't have 7, have 5. I had 4. My 4 boys, my oldest boy, he's already got 4. But the other 3 are thinking of 2, and the smart one's thinking of none. So don't get married so you don't get divorced. Don't have any children, you won't have any college. That's financial planning 101. Everything else is just the details.
Howard,
Howard,
Howard, how old are you?
58. I turned 59 this year.
Do you have any old buddies who never got married, never had any kids that are you still know and are in touch with?
I only know Bill Maher. He's the only one who reminds me of this on every one of his shows on Dentally or Politically Incorrect. You watch that show?
Okay. Well, people I know who never had kids, never got married, never had a significant other, they end up oftentimes in a very pathetic state, depending, right? So I don't know. I think financially you're maybe spot on, but as my great late father-in-law Jay Burkett told me, have more kids, it'll bring you good luck, and it's brought me nothing but great luck. And I'm sure you've gotten a lot of luck out of your kids as well.
Oh my gosh, my grandkids are well, my oldest one just turned 13, and so they're anywhere from 4 months to 13. And the 13 all the way down to 4 is already starting that whine. Why do you work so much, Daddy, Grandpa? Why can't you go play? And I'm really adjusting. I'm really dialing down I've worked 12 hours a day, 7 days a week. Since I ever remember. And hell, I got in dental school a year early. But yeah, grandkids are amazing and they teach you so much. But I want to tell you that a quarter of our viewers are still in dental kindergarten school. This podcasts are not for old guys like me. Most of my old dentist drinking buddies, they probably couldn't even figure out how to listen to my show. And one of them still calls it, is that radio thing you do? It's like, really? That radio thing you do? Why don't you just call me a ham radio? I want to go back to dental kindergarten. They're bright-eyed and bushy-tailed. They believe in Bitcoin. But can you succinctly tell? For me, it's just common sense. Look at Tesla. I drove to work today. I don't know how many cars I drove by, but it must have been thousands on the way to work. And I didn't see one Tesla, but it's worth more than 4. Mostly around here, I see F-150s, F-250. My God, you hardly never see a Tesla, but it's worth more than all the other car companies. Bitcoin. Do you know, have you ever had has a patient ever paid you for any dental service on Bitcoin? Has your wife ever gone to the store and bought something on Bitcoin? It's like, it's like you asking me, are Mickey and Minnie Mouse, are they brothers and sisters or man and wife? Or I was like, okay, it's a fantasy, right? So to me, I don't even know where to start explaining to these kids that if you're putting your money in Bitcoin, I guess it's better than drugs, but what do you think of Bitcoin? Or how could you explain that to someone in dental kindergarten?
I can't explain it. I think what everybody ought to go through is they ought to go lose some money. Go buy some Bitcoin, go buy some Tesla, open up a Robinhood account, put some significant money in. If that's $1,000 for you, great. That's what I've done with all my kids. Just put some money in that one and go buy all these companies that you think are great. And I'm just waiting for them to lose money and have that sick, horrible feeling that you screwed up. And you think to yourself, I know what I had to do to make that money, and I've just flushed it down the toilet. When you get that feeling, then come talk to me, because then we can give you some investment education. But it's very hard for people who have that fear of missing out and want to play these games. Bitcoin, to me, it's in the category of gold and other things where you're not buying an asset for its cash flow production. In investing, we buy things because, you buy a share of Apple, it's going to earn you money. You'll get earnings per share. You'll get your earnings for that share of Apple. That's the whole point of owning and investing. But buying something because somebody might buy it from you later down the road, that's speculating to me. So, we got to draw that distinction. Are you speculating or are you investing?
And DSOs are doing it to dentists all the time. I mean, when they open up an office, they have metrics that this has to pass. And you need to have 7 root canals a month, so many extractions filling. And when they open up and they realize these demographics didn't work, most of the DSOs, like the rich suburbs with median household income greater than $60,000 a year. But when they know they're a dud, they know the greater fool theory works. I don't care what Tesla's trading at today. If you own a share, you can find someone actually dumber than you to buy it from you. And no matter how smart you are, someone's smarter. And no matter how dumb you are, someone's dumber. But I want to dumbing it back down to the dental students. And because I'm mostly worried about them. When you're a grandpa, you're not worried about old dentists that are rich. You're worried about these young kids. Can you explain to them why they would want a 401k plan than, say, just putting their money in a savings account buying stocks? Well, and what does that even mean for 401k? I know that I've ran 3 marathons that were 26k, and that was not fun. So when you're telling me that I should run a 401k, I'll pass.
Yeah, well, 401k is just a section. It's just a section of I think it's the Department of Labor. It's a code section. But here's the deal: the U.S. government says to you, "Hey, you're going to go work, and it's in our best interest that when you can't work anymore, when you get to be, Mitch and Howard's age and you want to retire, it's in our best interest to make sure you've saved up enough money so you don't have coming for us and get on the dole, in a soup kitchen. So we want to help you save. So instead of paying taxes on some of the money you're making, you can put it in this special account and we won't even count it as income from you that year. So if you make $100,000 and you want to take 20 of it and put it in this account, to us, we'll tax you on 80 grand. And you can throw that 20 in the account and then you can grow that account. And not only did you get to take it off your taxes, it's going to grow without taxes while you work. So if you buy Tesla with your 20 grand and you turn your 20 grand into 40 grand, which I don't suggest, but if you did and then you sold it, you don't have to pay any taxes on the 20 grand of profit. And that can go on and on and on until you're 72 years old. And then with this retirement account, we're going to look at how long you're going to live. And we're going to use some tables. And then we're going to say, well, you got 3% of your life left and you got to take 3% out. And then we're going to start making you pay taxes on it. But from now till you're 72, you can throw it in there to certain limits. It'll be deducted off your taxes. It'll grow tax-free. And then you can start taking it out. And it's a wonderful thing. And so anybody who's making money today and paying some taxes that doesn't use a retirement account, you're crazy. It's the best deal going. It's one of the greatest things the U.S. government's ever done to incentivize workers. Now, how you invest it inside that plan, that's a whole different conversation. And one reason why we got into the business, because we felt that the whole industry was sort of screwed up and started from some very bad ideas. But, if you pay attention, then it'll grow to very, very, very large numbers. Here's a good rule. It's called the rule of 72. Divide into 72 what return you think you can earn on your money, and that's how many years it'll take to double. So you're a dentist. You're 35 years old. If you can put money into something that'll double in 10 years and you're 45 and then you're 55 and then you're 65, that's 3 doubles. 2, 4, 8. That's a big amount of money. You're contributing to that every year. It'll become a very, very large number. It's the secret of Warren Buffett. It's the secret of any wealthy person other than an instant, not an instant, but a quick millionaire in a technology. It's the concept of compounding, the magic. It's like a snowball. You make a little snowball with your hand and you push it down a hill, and very quickly you have a boulder. Money works the same way. And a 401k plan or an IRA, one of these plans where you can put money in that you've earned and not pay taxes on it and let it grow without tax for decades, that's a very magical way to retire and have a way to not have a lot of stress when you get to be our age.
Another thing I've noticed a lot is that when dentists have to work, when they realize someday that they're going to have to just keep this level going just to make all their minimum monthly payments and all that kind of stuff, it starts playing with their mind. And then the other side of that is the dentists who retire. They did everything right. They didn't get divorced. They lived below their means. And they finally realized, I can sell my office and retire. Oh my God, within a year, they're stir crazy and they're going back to work. And I remember even Bob Ibsen, when he sold Denmat and Rembrandt to, I think he sold it to Gillette, or he sold his Procter and Gamble, which turned around, got absorbed by Gillette or whatever. I think he had, like, after taxes, everything, he had like $250 million in cash. He didn't even retire for a month, and then he realized he just went and set up a charity dental office in Santa Maria, California, and just did free dentistry on older people, or on economically disadvantaged people. But my gosh, what I think is the best about living below your means is you don't have to make a bunch of money to make the house payment. You don't get depressed. It plays mind games. Do you know what I'm saying? And do you agree with that? That when you have to work, it's very different than when you want to work and don't have to?
Yeah, it's a very different animal. It's seasons in one's life as you age, right? So, there's a season where you're cranking really hard. There's a season where you say to yourself, I have enough, but I still like the game. I would say the major, there's so much of our business that's psychological. We deal with clients and the people who were hardest hit in our client base during the coronavirus were the 75-year-old retired guys who, looked at their accounts during that bleak part of March and said, oh my God, what if this keeps happening? I'm never going to be able to make money again. My time horizon isn't 50 years anymore. It's 10, 15 years. And that's a heady thing. So sure, I think having enough money to retire or knowing you're going to have enough money to retire is a very big deal. I'm in the peace of mind business. I'd say the biggest thing that we do for clients to get them peace of mind, number one, is make them understand how the way we invest will over long periods of time, maybe rolling 5-year periods, 10-year periods, get them the results they want in a very safe, rational way, and that we have a process for doing that. But second, people really ought to have a customized financial plan. And a financial plan, people give these away all the time. Most people I ask, have you ever had a financial plan? And they go, oh yeah, my broker over at Fidelity ran one for me. And I said, oh, what'd you do with it? Oh, I don't even know where it is. Did it inform your thinking about your future? No, I don't even know what it said. Why? Well, it was 80 pages and I had no idea what pages and pages of numbers. But that's not the way it ought to work. If you have a plan that incorporates every little bit of your life, when are you going to get Social Security? How much is that going to be? What assets do you have? What do they throw off in cash? What's a reasonable rate of return for your retirement accounts? When it really lays it out and you look at it and your net worth continues to grow even after retirement with some assumptions that you say, it can't get any worse. That's where you get peace of mind. That's where you feel comfortable. That's where you look forward during bad times in the market like COVID or heady times in the market today where you're worried it might blow up. And you say, I'm going to be okay. I'm going to be okay.
On one of these threads, it's talking about a simple IRA through Vanguard or TD Ameritrade or Schwab. And you made another profound post, like all your posts. You said, have you considered a cash balance plan? Dentists who are looking for reliable retirement investment options can always trust a 401k plan. However, a lesser known approach, the cash balance plan, is another great option for providing dental practice owners a secure retirement. Depending on your cash flow and personal financial goals, combining a 401k with a cash balance plan or going entirely to a cash balance plan can open doors to financial possibilities that seemed decades away at first, all the while providing powerful incentives that will help you retain staff. Cash balance plans are a type of retirement savings investment plan that allows dental practice owners who have high incomes, but who may have begun saving for retirement later in life to catch up. These plans are also owners or partners to greatly increase retirement savings today by deferring tax on far larger amounts than traditional 401k plans allow, up to $300,000 annually. What is the cash balance plan?
Yeah, let me try to make it simple, Howard. All right. So if I told you, with a 401k, you can put in, if you're running a practice, maybe you can put in with profit sharing up to about 60 grand every year. cash balance, $2.5 million. Think about imagine having the ability to contribute over the next few years, $2.5 million of pre-tax income into a retirement plan. Well, that's what a cash balance plan allows you to do. The big picture here is you're setting up a relationship with your own corporation or your LLC, where your LLC is giving you like a pension, like the teachers union or the old people who used to work at big American corporations got a pension. You retired, and the company said, well, Howard, from now on, you're going to get, X thousand dollars every month until you retire, until you die. We're responsible for that. We're going to write you a check. That's the relationship you're setting up with your own corporation. And so your corporation, as your employer, is responsible for putting enough money away so that it can fund the pension obligation that it has for you. And so these are pretty sophisticated, but they're actually, simple to set up if you know what you're doing. And basically, you can fund your own pension and put away up to $2.5 million throughout your career. So you decide how old you are today, when you want to stop working. And throughout that period of time, you have to put that kind of money away to get your pension funded to pay your salary after retirement. So it involves actuarial work. It involves all kinds of things, but it's really worth it, because if you can do it and get it set up right, you can literally put away, tax deductible, hundreds of thousands of dollars a year into these plans. And then it grows tax deferred. And then when you actually do retire and the plan begins to pay out, you can roll it into your own personal IRA. So if you've ever seen people with millions of dollars in an IRA and they're in their 70s and they're retired, you can always assume they had some sort of a cash balance plan like this.
So one of the things that, in fact, it's so funny that I'm podcasting right now, because when I walked in here, my comptroller for 20 years wanted to give me a 401k update and all this kind of stuff. But when you talk about, what I tell her is I don't really, I'm never going to touch it until I can't earn a dollar anymore. I mean, I think working is a big part of mental health. I've seen those charts when longevity, like for instance, my two oldest sisters are nuns, right? And the oldest one, when the nuns actually die in the Carmelite monastery, they bury them in the garden. They're on a 6-acre complex. And it's like the average age of a buried nun out there is over 90. I mean, they're all like 90 because they have no stress. They didn't work. They didn't have a husband. They didn't have kids. They didn't have any of this stuff. And they just have the stress free. And whenever you go talk to her, when you're talking to the whole group, all they do is giggle. And you're like, oh my God, it used to be too good of a life. But I think a lot of individuals think that, well, I'm going to need that 401k in case I have a medical issue. So then they start overthinking and say, well, what's more important, long-term health care insurance or a 401k?
Well, these are all individual issues, Howard. I mean, most people that we deal with for long-term care, they have enough money put away where they can self-fund something like that. The insurance policies tend not to be that good because, you're paying somebody else, you're pooling your risk with other people. But, when you put money into these retirement accounts, at 72 years old, you have to start taking it out. With certain exceptions. But, I would have to say to you, these are the kind of things that a really well-scrubbed financial plan with somebody who really knows what they're doing is important. I mean, financial planning, it's like taxes. You can go to H&R Block and they can jam out a tax return, or you can go with a really good, sophisticated CPA who's going to show you the ins and outs and things that you can do that might make a big difference down the road. I hope I'm answering your question, but that would be my response.
You are, and I want to ask you about one more hero of mine. So I was born in Wichita, Kansas. So I went up to
no kidding.
Yeah,
Wichita, huh?
Yeah. Why do you know Wichita? Or?
I've been meeting so many people from Wichita recently. Gotten to know some families in Wichita. My son, throughout COVID, ended up playing golf with a bunch of guys that are a half a century older than he is, that are all from the Kansas area in Wichita. So I don't know. It's just funny you mentioned it.
I loved it. I mean, my God, it was home of Dan Carney, and I remember in high school, whenever you had a great business idea, you'd go to Pizza Hut headquarters and you could walk right in there all the way to Dan's office. I mean, the only person that stopped you was the last secretary by the desk. And when you said, "Can I ask Dan a question?" she would just giggle. But Kansas didn't have a dental school. And so I went up to Creighton. And because my mom wanted me to stay in Catholic school, I'd been in Catholic school my whole life, St. Pat's, Blessed Sacrament, Bishop Carroll, then Creighton. And I signed up for Business 101. Guess who the teacher got to come over and teach a class for us? Warren Buffett, the Oracle
No
of
kidding.
Omaha. And to tell you, I mean, I don't think anybody needs proof about how stupid I am, but just to give you a proof of how dumb I am, we had to write up a deal afterwards of what we thought of his speech, and we got 10 extra credit points. I said, he's the dumbest guy I ever met in my life. I mean, I was all excited about the Nifty 50 and Kodak and all these technologies and Polaroid and all this stuff, and I said, well, or what do you love about the Nifty 50? What's your favorite? He's like, Nifty 50? No. He says, if I can't take a 5x7 index card and a number 2 pencil and write out what this business is and how it makes money, I'm not buying it. I don't understand any of that high tech. And then he starts talking about the companies he's in, and he's an old man. He's got these bushy eyebrows. I'm like 18. I'm like, this guy's an idiot. Why didn't you have him come talk? And of course, turns out to be like the smartest guy. But I noticed that the narratives have to change to get into these bubbles. And humans believe when people say, why don't these investors know it's a bubble? My God, they believe the craziest things in the world. I mean, look at all the things they believe that are completely fictitious and not made up. But in changing the narrative, you got to have this great storytelling. In fact, who's that Nobel Prize winning economist that just wrote the book Narrative? Nobel Prize winner Robert Shiller. I mean, I just love listening to Shiller. I mean, I have forever. He reminds me of my favorite Austrian economist, Joseph Schumpeter. He really does. He's like a Schumpeter reinvented. But they change the narrative. And one of the things you see right about, say, real estate. You would never go to a car lot and they say, okay, this car costs $1. And you'll say, well, I'll offer you $1.10. But that's what they're doing at the tops of all the bubbles. Like, well, it's listed for $250, but I think you should put in a bid for at least $260 or you're never going to get it. I mean, people are bidding up their house with their brokers. And now you start seeing a lot of Warren Buffett trashing that, he's lived past his prime. He's too old. He's old school. Yeah. And it's like, dude, if this bubble means that now Warren Buffett's an idiot, speak no more, because I already know how out of your mind you are. But what are you thinking of Buffett right now?
Oh, I love Warren Buffett. I mean, you caught him before anybody knew Warren Buffett, 40 years ago or so. I mean, no one had heard of him. Look, I think Warren Buffett is the Benjamin Franklin of our generation. I think what he says makes so much sense, not just from investing, but in life. By the way, in his last several annual reports, he has talked quite a bit about the cost of investment management, the cost of hiring helpers like me, the cost of that and how significant that can be. He's also recommended that you buy an S&P 500 index fund and forget the rest of it. He's basically said, without saying, very few of you are like I am and as good as I am, or people that work with me. And unless you think you are, which you probably aren't, just go buy an index fund and forget about it. So I think, he has confirmed a lot of things that we do as investors, irrespective of how he's made his money. But I don't believe that a Warren Buffett, goes in and out of style for my money. I mean, he's just he's a true one of the greatest investors, obviously, that's ever lived. But he's very wise. And not just Buffett, but his partner, Charlie Munger, if you've never really gotten to know him and some of his great ideas, these are very important men to really study and understand. Munger's biggest concept as an investor and as a human is to stand on the shoulders of giants. In other words, he read various disciplines in life growing up and still does. He wants to understand the greatest thinkers in philosophy, the greatest thinkers in psychology, the greatest thinkers in physics, in investing, in economics. And then he has these mental models that he can apply to a problem from various dimensions in different ways. So anyway, I can't say enough. One of my proudest things on my wall is me and my dad having a picture with Warren in 1999 at Garat's Steakhouse during an annual meeting we attended. So I'm very biased, but he's been my mentor and he doesn't even know it.
That is so cool. So you made a continuing education course on Dental Town. What made you make that course, and what were you trying to what was the major message that you were trying to get through on that course?
Well, and we can give CE credit because it's ADA approved, but the basic idea is that this is a long conversation, but the way the 401k plan has evolved over the last 40 years to replace pension plans, big corporations found that they were, promising people lifetime payouts of their salary. And when they looked at it, they couldn't afford to do it. And they got hammered financially for a period of time during the 70s. So they decided to stick it to the employee and say, we'll put a plan together, but the savings has got to come out of your pocket and we'll match it a little bit. When that whole thing changed around and the modern 401k was invented, because of a variety of reasons, it really got set up so that the employee could not sue the employer for putting a plan together and for managing money for the employee. So it really attracted a lot of people in the business that set these plans up for a variety of reasons. But what we realized is missing is ultimately these plans are set up so you can grow your money and retire with more money. And to do that, the plans can't have a lot of fees in it. They can't have conflicts of interest in it. And when we began, we're wealth managers. So we come at this from how do you make money grow? We're not paychecks, which comes at it from, hey, how can we process as many people's 401k accounts as we can every week and make nickels for every person on the plan? Or we're not an insurance company that's thinking, well, how can we stuff the plan with a bunch of high-priced funds that we can siphon money out of? We just think of it like, what's wrong with these plans and why are they so screwed up and why aren't people getting the results that they want out of these plans? So we decided to put a course together to educate dentists about the plans so that they could be fiduciaries, proper fiduciaries for themselves and for their staff. And we just felt that it was a very important part of running a dental practice, because you're trying to help everybody on the team retire with more money. And the ADA liked our idea and allowed us to put that course together. So people who go through that course, we do it on a webinar, Howard, and people stay the whole time. I think it's a very important course that we've been able to put out there.
Yeah, I thought it was a great course, but I love that. I have two loves. I really do. Dentistry and economics. I got a dental degree, and I also have an MBA. And I got an MBA because my dad taught me everything I know about business and all that stuff. And I just wanted, I felt like I was a dental assistant, where my dental assistants have been with me 10, 20 years, could do any type of dentistry known to man. But they're, they don't have the formal degree. So I went back and I got the degree and the MBA and all that kind of stuff. But I just love it because the thing about business is, like you were saying about Charlie Munger, everything helps to know about math, physics, chemistry, biology. The more you know, the more information you know, it forms kind of like a quantum entanglement where it all starts to make sense. And what I see coming up on 59 this year is it just gets more clear every year that goes by. And that's what the whole deal of the podcast is how can you transfer knowledge from a bunch of old farts like us to these young kids? Because I really feel like when I got out of school, you could really make a lot of dental mistakes, screw ups, and you'd be fine. You just go with the crowd. But now when you're coming out $400,000 student, it's like, look at Phoenix. When I got here, there was no water fluoridation. There were no dental schools. There were no dental schools in the adjacent states of Nevada and Colorado, and now there's schools everywhere. You got DSOs coming out. And that'll be my last question I want to ask you, because that's a big question for a lot of these dentists that are getting older. They had underfunded 401ks. They still want to work, but they think, okay, I have an office and it's worth $1 million. If I sold it to a DSO, I could pull out my money, pull out my equity, never let your money get too far from cash. I could convert my equity to cash, and they want me to work 3 years. Like, hell, I'll work till I can't work anymore. What do you think of that approach of selling your asset for cash and then become an employee? just even for more savings?
Well, you have to, it's a financial equation and an emotional equation, right? So on a financial equation, so you get your $1 million in cash and then you pay your tax on it. So if you're living where you live, you pay federal tax. If you live where I live, you pay a lot more because you pay state tax. So there's a net number. And then you compare that against what you could make just continuing to run the practice on your own. That's a lot of where we get calls about cash balance plans, because people who are in that position are making so much money, but no one's ever recommended to them. Their CPA, they've just never heard of the idea that maybe they could put away a lot more money. And so it makes more sense just to stick around and keep running it yourself, because you're having the government fund a lot of that taxes. But I think it's a financial equation, but also an emotional equation, because as you get older, if you don't have the dental practice management stuff put in place, everything's a fire drill, everything's stressful. So, you're trying to take care of your patients and then you're trying to take care of the practice. So if you're in that position and you say to yourself, I capitulate, maybe I'm not a great businessman, maybe it's time to give it away. That's oftentimes a better idea too. So I think it's financial and emotional. If anybody, wants to figure out the financial side, that's fairly easy to do. We've done that for people, and we can, others can do that. But the emotional thing is probably a bigger deal.
My last question. Just the low-hanging fruit. What are the ways that you can just mess up your 401k? There's probably a lot of dentists listening like, oh yeah, I don't need to listen to this. I got a 401k. What are ways you can screw up your 401k and not know it?
Yeah, three or four big things. Number one, if you got your 401k put in place years ago by your buddy who sold insurance and you haven't looked at it, you're probably screwing up your 401k. Okay. I mean, hands down, if you haven't looked at it and you had your old insurance buddy or somebody from Transamerica or John Hancock sell you a 401k and you put it away, and you're probably screwing up. You owe it to yourself and your staff to at least have somebody take a look at it. Okay. That's number one. So number two, if you don't understand the fiduciary relationship you have with you and your staff, if you don't fully understand what that means, you're screwing up, because there are all kinds of lawsuits happening now with people like you, like a dentist, about these 401k plans, and they don't fully understand that they have assumed a very large fiduciary responsibility for the investment of that plan, for the choice of the investments. If you don't really understand that, you're screwing up, okay? And finally, I got two more quick ones. Third, and this kind of goes with the first, if you don't really understand the fees in the plan, you're screwing up. And it's hard to understand the fees in the plan because they're hidden in the funds that are in your plan and all over the place. And you need somebody like us to go help you figure that out. And finally, if you haven't figured out the best way to use these tax optimization strategies like cash balance plans, et cetera, then you're missing out. So I would say, those four things. That'd be my final answer, I guess, huh?
And my final narrative will be, one of the things I did not learn from Warren Buffett, which he clearly taught us that day, was, the things that you don't ever go into or invest in are things that are capital intensive, and when someone else sets your fee. Healthcare is the most capital intensive, and the insurance companies and the government sets our fee. I mean, Warren Buffett, I remember him talking about that because Creighton had a big medical school and dental school, and he told us he thought that was, it was a great profession. It was a sovereign profession. He's glad people did it, but from an investment strategy, he thought that was crazy. And then my dad used to always sing to me, you'd ask him a question, and he had so many one-liners, but he'd say, the easiest dollar earned is $1 in expenses saved. The second easiest dollar earned is $1 in taxes delayed. But the hardest blankety blanking dollar you're ever going to make is go back to work and make another dollar. So, just live below your means, and like he said, save the taxes from the mob, and my gosh, just be smart about it. And Mitch, seriously, man, I think what you're doing on Dental Town is amazing. You're giving great advice. You're helping them. You're schooling them. You're like the Warren Buffett on Dental Town. You really are, man, Mitch. I mean, how old are you? You asked me how old I was. How old are you?
64.
64. I mean, and you're educating 24-year-olds, and you're saving them a 40-year journey of stupid mistakes.
I try, but the first thing they need to do is get a Robinhood account and lose some money, and then come talk to me, because until you do that, you still believe in the dream, and the dream, the siren song. So, but I appreciate all your kind words, Howard, and this has been great fun. And congratulations to you on your business. You've gone from Merrill Lynch to dentistry to education, with a stop with your nun sisters, all the way over to being a media mogul here, huh?
And I feel like I've never worked a day in my life, and that's why I told my boys, when they said, well, I don't want to go into dentistry. I said, well, I didn't want to go into Sonic Drive-In and make hamburgers and French fries my whole life. I said, you only live once, just do it smart. And I'm telling you, kids, I don't know what it is about doctors, dentists, lawyers, physicians, but they just completely live above their means. And I don't know about your self-esteem, but I mean, I know dentists that just walked out of AT Steel and Midwest are $400,000 of debt, met some girl, they've been dating like 3 months, and they're already proposed and going to get married. It's like, slow down, Spanky, enjoy the courtship. I mean, well, what is she, pregnant? I mean, what, marriage isn't even a thought until you want to get married and have offspring. But gosh, you're dating someone and you got to get married, because I know what the marriage attorneys are going to do when that goes south. And living below your means, I mean, you just never sit down and realize what that $80,000 BMW is going to cost. So have some self-esteem, man. You don't need a Mercedes-Benz. You don't need a dental McMansion. And if you're with some girl and after the third date wants a big diamond ring and marriage, you're getting taken to the cleaners.
You know how Warren Buffett always talked about, spending money and living above your means, is somebody would say to him, well, you can buy a $20,000 car, or why don't you buy the $40,000 car? And he'd say, well, I can buy the $20,000 car. And they'd say, well, you'd enjoy the $40,000 car more. And he'd say, well, but if I have that $20,000 to invest, in 10 years, it would become 40, and then it'd become 80. And then, so that extra bit on that car would cost me $250,000. And if you think of money that can be put away and compounded over decades as the real cost of that extra expenditure, it's very sobering. So.
All right. On that note, thanks for all you do. And I'll have you come back on the show after the crash, just so I can tell everybody, I told you so. And on that note,
Howard, next time there is a crash, have me on the show, and we can calm a lot of people down, because there's always a lot of data and always a lot of sobering information people need during those periods of time.
I know. And when people say to me, are you a doom and gloomer, the end of the world? It's like, dude, I've lived through this 4 times. I mean, right. I'm not scared of it. I understand it. I just think you should know, like a meteorologist, you just know there's a thunderstorm coming and you prepare
exactly.
for it. And then it'll blow over.
Weather.
It's just weather. It changes every day.
Yeah.
All right, buddy. Have a great day.
You too, Howard. Hey, thank you so much.